Hey, quick one for you today. After years of doing the work, I've noticed something. The clients who get the best results, the fastest results, the clients who get the best results, the fastest results, the most lasting results, they all have one thing in common. They understand how credit actually works before we even start. The clients who struggle, they come in believing things about credit that just aren't true. Stuff they heard from a cousin, saw on TikTok, or picked up from some finance guru on Instagram. So I'm going to save you some time. These are the 7 things I wish every single person understood about credit. If you get these, you're already ahead of 95% of Americans. Let's go. Number one, your credit score is not one number. First one. And this one blows people's minds. You don't have a credit score, you have dozens of them. So when you check Credit Karma, you're seeing a Vantage score. When your mortgage lender pulls your credit, they're seeing a FICO score, specifically FICO 2, 4, and 5, depending on the bureau. When you apply for a car loan, the dealer is pulling FICO Auto Score 8 or 9. When you apply for a credit card, it might be a FICO Bank Card score. These scores can be 30, 40, even 80 points apart from the same credit report on the same day. And this is why people call me freaking out saying, "Hey, Credit Karma says I'm a 680, but the mortgage lender says I'm at a 610. What's going on? What do I do?" Nothing is going on. You were just looking at two completely different scoring models. So here's what you need to know. For most major purchases, mortgage, auto, business funding, lenders use FICO, not Vantage. So if you're trying to qualify for something specific, you need to know which score the lender is going to pull, and you need to be watching that number. Credit Karma is fine for trends. It's fine for seeing is my score going up or down, but it's not the number that determines if you get approved. So stop treating it like it is. Number two, utilization is more powerful than you think. Number two, credit utilization. This is a percentage of your available credit that you're currently using. If you have a $10,000 limit and a $3,000 balance, your utilization is 30%. Now, here's the part that people don't know. Utilization is the second biggest factor in your FICO score. It accounts for 30% of your score, and unlike payment history, which takes years to build, utilization can change your score in 30 days. This is the fastest lever that you can pull. But here's the twist. Most people think just keep it under 30%. That's what the internet tells you. That's outdated. The sweet spot for maximum score benefit is actually under 10%. And for a perfect score, it's between 1 and 9%, not 0, because 0 utilization can actually hurt you. The algorithm wants to see you using credit responsibly, not using it at all. Here's another thing most people don't realize. Utilization is calculated per card and overall. So if you have 3 cards, 2 at 0 and 1 maxed out, that maxed out card is killing your score even if your overall utilization looks okay. And one more. Utilization reports based on your statement balance, not your current balance. So if you pay your card off on the 15th, but your statement closes on the 10th, the bureau see whatever you owed on the 10th. Now, that is why people pay their cards off every month and still have a high utilization showing on their credit report. The fix? Pay down your balances before your statement closes, not after. Small change, but massive score impact. Number three, closing old credit cards is usually a mistake. Now, again, please, please hear me on this one. Stop closing your old credit cards. I can't tell you how many times someone comes to me and says, "I'm trying to get my credit in order, so I close that old card and I don't use it anymore." And I just wince because they just torch their own score. Here's why. Closing a card does three bad things at once. One, it lowers your total available credit, which raises your utilization ratio. Remember what I just said about utilization? Two, it hurts your length of credit history, which is 15% of your score. Old accounts are gold. That 12-year-old card you never use, that's anchoring your average age of credit. Close it, and your average age drops. Three, it reduces your credit mix, which is another 10% of your score. So the only times closing a card makes sense is if it has a high annual fee you can't get waived, or if there's some kind of fraud or account compromise situation. Otherwise, just leave it open. Put a small recurring charge on it. Netflix, Spotify, whatever, and set it to auto pay. Keep that account active. Keep the history building. Keep the available credit on your report. Your future self will thank you. Number four, hard inquiries barely matter, but applications do. So, number four, the inquiry myth. People are terrified of hard inquiries. They regard their credit like it's a nuclear code. I can't let them pull my credit, it'll wreck my score. Reality. A hard inquiry drops your score by about 2 to 5 points, and it only affects your score for 12 months. It falls off your report completely in 24 months. In the grand scheme of things, it's basically noise. What actually hurts you is multiple applications in a short time because that tells lenders you're desperate for credit, which is a risk signal. But here's a nuance that most people miss. For mortgages, for auto and student loans, FICO has something called rate shopping protection. Any inquiries of the same type within a 14 to 45-day window, depending on the scoring model, count as just one inquiry. So you can shop multiple mortgage lenders, multiple auto lenders, and it counts as just one hit. This does not apply to credit cards. Every credit card application is a separate inquiry. So if you apply for 5 credit cards in a week to chase sign up bonuses, you're taking 5 hits, the takeaway. Don't stress about one inquiry. Do be thoughtful about applying for multiple new credit cards in a short window, especially if you're about to apply for something important. Number five, paying off a collection can actually hurt your score. Number five, this one's going to sound insane, but stick with me here. Paying off an old collection can sometimes lower your score. I know how it sounds, so let me explain. Here's what happens. A collection on your credit report has a date of last activity. The older the date, the less the collection impacts your score. A 5-year old collection barely moves the needle. A 5-month-old collection is a score killer. So when you pay off a collection or even a partial payment, a lot of collection agencies will update the date of last activity to the date you paid, which takes that old dusty collection and makes it look brand new to the scoring algorithm. Suddenly, that thing that was barely hurting you is now crushing you. This is why you don't just randomly pay off old collections because someone told you to pay your debts. You handle them strategically. Options. You negotiate a pay for delete where the collector agrees in writing to remove that item from your report in exchange for payment. You dispute it properly and see if it can be removed through validation. Or sometimes you just let it age off. Collections fall off your report after 7 years from the original delinquency date, not from when you pay them. The worst thing that you can do is call up a collector, pay the full amount, get no agreement in writing, and watch your score drop 40 points the next month. I've seen it happen 100 times. Before you pay anything on a collection, get that strategy right first. Number six, authorized user accounts are a real hack if done right. Number six, let's talk about authorized users. If you have a family member with great credit, good utilization, long history, no late payments, and they add you as an authorized user on one or more of their cards, that entire account history can show up on your credit report. Think about that. You can basically borrow someone else's 15-year-old, perfectly paid low utilization credit card and have it boost your score. This is completely legal and legitimate. It's not a scam, it's not a hack. It's been in the FICO algorithm for decades. It exists because FICO recognized that young people with no credit history were being unfairly penalized when they had family members vouching for them. But, and this is important, it only works if these three things are true. The account has to have a long, clean history. If you get added to your cousin's card and that's 6 months old and max out, that's going to hurt you, not help you. The card issuer has to report authorized users to the bureaus. Most major issuers do. Amex, Chase, Capital One, Bank of America. Some smaller ones actually don't. And the person adding you has to actually trust you because technically you could use that card. Most family members handle this by just never giving the authorized user the physical card. You're on it for credit reporting purposes only. If you have someone in your life who could do this for you, it's one of the fastest legitimate score boosts that exists, worth having the conversation. Number seven, credit repair is not the whole strategy. Number seven, and this is maybe the most important one, removing negative items from your credit report is only half of the game. I see people obsess over disputes. They want every collection gone, every late payment removed, every charge off wiped clean. And look, that work matters. That's a big part of what we do. But here's the problem. If you remove 3 collections and your score goes from a 580 to 620, what happens next? You're stuck at 620 because the negative items were holding you down, yes. But now that they're gone, you've got nothing positive pulling you back up. A strong credit profile needs both. You need the negative stuff addressed, and you need positive trade lines, good utilization, the right mix of credit types, and time. And this is why people clean up their credit. They see a bump and then plateau. They did the defense, but never played offense. When you think about your credit, think about it in 2 lanes. Lane one, clean up what's hurting you. Lane two, build what'll help you. Lane two looks like this. Adding a secure card if you don't have many trade lines, asking for credit limit increases on cards you already have, Becoming an authorized user, just like we talked about, maybe a credit builder loan, making sure your utilization is optimized. The clients who win long term are the ones who do both defense and offense, cleanup and build. All right, those are the seven. To recap quickly, you have multiple credit scores, not one, right? Utilization is a bigger deal than you think and reports based on statement balance. Don't close old cards. Hard inquiries are mostly noise. Paying collections can backfire if you don't do it strategically. Authorized users are a legitimate score hack, and credit repair without credit building is only half the plan. If you understood all seven of those, you now know more about credit than almost anyone in your life, seriously. On our call, we'll take everything you just learned and apply it to your specific situation, what's on your report, what score you need, what timeline you're working with, and we'll put together the plan from there. See you soon.